When you are starting out in investing, it can be daunting to figure out which stocks to buy. For example, looking at Tesla, is today the right time to buy at $667 per share, or was it much better to buy a month ago? The chart alone will not tell you the full story behind a business, as stock market simply does not care about the true value of a business. There are plenty of ratios that could look to help you with analysis, such as working capital ratio, quick ratio, earnings per share, price to earnings ratio, debt to equity ratio, return on equity, bottom line, and many others. But the best way to figure out whether a stock is worth buying or not is to figure out its intrinsic and future value, and that's what we will do today. Welcome to the channel, it's Millennial Investor. If you are new here, smash the like button to help the channel grow, and today we will look at a couple of examples of how to figure out the intrinsic value and analyze a stock like a pro. To do an analysis like this, we will need somewhat stable companies that have analysts regularly analyzing and estimating the potential growth of the business for the next 5 to 10 years. You will also need to lay some ground rules for yourself, such as margin of safety or the minimum rate of return that you expect, but I will explain all of those in a second. Firstly, let's head over to a spreadsheet and go through this analysis together. Everything that you will see today will be using free online tools on the internet, so don't worry, I'm not here to sell you an expensive analyst tool that you would apparently need to make this analysis happen. The spreadsheet is pretty easy to build if you follow the steps correctly. Starting right at the top, put the name of the company that you are analyzing. For us, that will be Apple. Then below, write the following: EPS TTM, growth rate, minimum rate of return, margin of safety, and PE ratio. I will explain what all of those mean in a second. The first ratio that you see is EPS, or as it is well known, earnings per share, and TTM means trailing 12 months. This is a simple equation that divides the profit of a company that has been made by the outstanding amount of shares that they have. To find out EPS, we will head over to Yahoo Finance and then type in the stocks we are looking for, which for us is Apple, and right at the bottom, scroll down in the summary section, you can see EPS TTM 5.11. So let's put that in our spreadsheet. And that's our first figure done. Secondly, we have the growth rate. For this figure, we will look at reports from analytics that estimate the growth rate of a business for the next 5 years based on previous growth and other factors. To find this figure, let's go back to Yahoo Finance, and then in the analysis section, right at the bottom, if you scroll down, you can see the growth estimates. So we are not interested in next year growth estimates, we are interested in next 5 years growth estimates. So we can see 17.93% per year for the next 5 years. So let's put that in our spreadsheet, 17.93. Minimum rate of return is where you come in. That is the rate that you would like to have from a business while being realistic. Everyone would like 100% return on the trades that they make, but that is simply not possible. If you want to have a return that is lower than 8%, you might as well put all of your money in the S&P 500 index fund, as it's less risky and offers somewhat similar return. So investing in a single company usually comes with more risks, and we want a higher return for that. A safe assumption for a stock such as Apple would be close to 15%, so let's just put that in for the sake of this video. Margin of safety is another figure that you have to figure out for yourself. It will highly depend on your risk tolerance. Some people will have this number set as high as 50%, meaning that they want to pay 50 cents for a dollar, and some will have that number set to 10%, meaning they want to pay 90% for the dollar. For the sake of this example, let's be conservative and let's set it to 50% to make these calculations a little bit easier. And finally, to figure out the PE ratio of a business, we will go to MSN Money, another free website that you can use to analyze some stocks. Let's go to the stock that we are actually analyzing, which is Apple, and then go into the analysis section right here and go into price ratios. Here you will see two different price ratios, two different PE ratios. We have a 5-year high and a 5-year low. So what we want to do is put those two numbers together and then divide them by 2 to have an average of those two numbers. So 34.28, let's put that in, 34.28, and then the other one, which is 13.57 plus 13.57, and then divide the whole thing by 2. That gives us 23.925. So that's all of our figures done, and now let's make some use out of them. Now that we have all of our figures in place, let's assume we want to hold this stock for about 10 years and estimate its future value. Then we will work backwards to see if the current value of the stock is at a fair price. Create a simple 10-year table like you see on the screen and enter EPS figure in the first year. So for us that's 5.11. Let's put that right in the first year, and that's our EPS, earnings per share, for the first year. What we want to do with that number is make it grow for the 10 years, assuming the growth rate that we have, so 17.93. So to figure out the EPS for the second year, what you want to do is start the formula with an equal symbol, take the first number, type in the plus symbol, open your bracket, then type that number again, so it's E12 plus open bracket E12, multiply it by the growth rate that we have found out, which is 17.93%, and then close the bracket. What you also want to do is lock this value in. That's going to make it much easier to assume the EPS for the next year. So you type in the dollar symbol before the D and after the D, like so. Then press enter, and we have the assumed EPS for the second year. So just drag that number across, and what we have found out is the EPS for the 10th year of Apple. As you can see, the future EPS value is at 22.54. Once you figure that out, we can move to working with PE ratio. This time starting right at the back and multiply the EPS of year 10 by the PE ratio. So let's do that. We go and multiply the EPS of the 10th year by the PE ratio. So the value of the stock in 10 years is at around $540, but what we want to find out is whether the stock right now is at a fair value. So we have to work backwards. In order to do that, we have to take this figure and then take away the 15% of minimum rate of return that we want to achieve for every single year. So doing that is pretty simple. Let's just take the number that we have, $540, and then we have to divide it by the minimum rate of return. So you open the bracket and then type in 1 plus the minimum rate of return, and that's it. Close the bracket and make sure to lock the value, so just dollar symbols behind and before the D, and we have $469. Now we can drag that over all the way to year 1, and we can see that $153 is a fair value and fair price for an Apple stock. But what we want to do as value investors is apply the margin of safety. You obviously don't want to be buying for a fair value, although that might be true for some companies such as Apple, which might be a great buy at a fair value. So we always want to apply margin of safety, and to do that, all we have to do is take the figure from year 1, the fair value, and then multiply it by our margin of safety. Just remember that 50% is really conservative and a really high value, so you might want to apply a smaller margin of safety when you're doing your intrinsic value formula research, and that works out to be $76. So if an Apple stock drops down to $76, I would be loading up on the stock personally, but because it is Apple, it is a stable company that is expecting and estimating really good growth rate and has promising products on the market that are selling like crazy, you might want to decrease the margin of safety to like 25% or even 20%. It is one of the biggest holdings for Warren Buffett, and there is no reason that it shouldn't be one of your biggest holdings as well if the price is right. So that is it for this video. If you guys enjoyed it, make sure to let me know in the comment section down below. Smash the like button to help me grow, subscribe to the channel to see more, and I will see you in the next one.